There's a promise written in the code of every financial system on Earth. Not in ink, not signed by anyone you can name, but it's there, repeated, stacked, borrowed against, and then borrowed against again. The promise is simple. I'll pay you back. That's it. 3 words holding together $35 trillion in the United States alone, $130 trillion globally. These aren't handshake deals between neighbors. They're instruments with serial numbers, legal documents, tradable, resellable, built to circulate forever. And here's the part that should make you pause. Nobody expects them to actually get paid back. You've heard people talk about government debt. You've seen the headlines, the ticking debt clocks, the politicians screaming about fiscal responsibility while voting for more spending anyway. But what you probably haven't heard is that this debt isn't a bug in the system. It's the operating system. The IOUs issued by governments, particularly U.S. Treasury securities, aren't just accounting problems for future taxpayers. They're the closest thing the global economy has to gravity. Banks need them to prove they're stable. Pension funds need them to generate returns. Central banks need them to control interest rates. Other countries need them to park their trade surpluses. The debt is the collateral. The debt is the safe harbor. The debt is, ironically, what makes people feel secure. And that creates a very strange incentive structure. Because if everyone needs the debt to exist, then paying it off becomes almost inconvenient. Let's start simple. When a government spends more than it collects in taxes, it needs cash, so it issues a bond. Let's say a 10-year Treasury. That bond is a promise to pay you back your principal plus interest at the end of those 10 years. You buy the bond, the government gets your money now. Everyone's happy. But here's what makes this different from regular debt. These bonds don't sit in a drawer. They move. A pension fund in California buys treasuries. Then they sell some to a bank in Frankfurt. That bank uses those treasuries as collateral to borrow cash overnight from another institution. That cash gets lent out. The cycle repeats. One bond, multiple owners, multiple uses, all happening simultaneously through a system called the repo market. Repo, short for repurchase agreement. It's a mechanism where you sell a security today and promise to buy it back tomorrow at a slightly higher price. That price difference is essentially interest on what's functionally a very short-term loan. The repo market processes somewhere around $4 trillion in transactions every single day in the United States. 4 trillion daily. Most people have never heard of it. Why does this matter? Because treasuries aren't just investments, they're the oil in the machine. Banks use them to meet regulatory requirements. Money market funds use them to stay liquid. Foreign governments use them to stabilize their currency. And everyone treats them as if they're cash, safer than cash actually, because they pay interest. Which brings us to the uncomfortable part. The United States has never defaulted on its debt. That's the line you hear, the bedrock promise, and it's technically true. But let's be precise about what that means. It doesn't mean the debt got paid off. It means every time a bond matured, the government issued new bonds to pay back the old ones. It rolled the debt forward. It still does, constantly. Right now, the U.S. national debt is around $35 trillion. The entire U.S. economy, every good and service produced in a year, is about $28 trillion. So the debt is now larger than the GDP. Here's the math that should bother you. The interest payment alone on that debt is over $1 trillion annually. Not paying down the debt, just servicing it. That's more than the defense budget, more than Medicare. It's the fastest growing part of the federal budget, and it's mandatory. You can cut education, you can cut infrastructure, you cannot stop paying bondholders without triggering a global financial crisis. So the government borrows more to pay the interest on what it already borrowed. Let that sit for a second.
We've built a system where the debt can never be repaid. It can only be rolled over, endlessly, as long as people keep believing the promise. And most of the world does believe it, because the alternative is unthinkable. There's a strange poetry to this arrangement. The safest asset in the world is an IOU from a country that's functionally insolvent by any household standard. If you or I tried to pay off our credit card with a new credit card every month, eventually someone would cut us off. But when the US does it, investors line up to lend more. Why? Because US Treasuries aren't evaluated like normal debt. They're evaluated relative to everything else, and everything else is worse. Europe has its own debt troubles. China's growth model is cracking. Emerging markets are volatile. Gold doesn't pay interest. So money floods into treasuries, not because they're objectively safe, but because they're the least bad option in a world where true safety doesn't exist. It's a beauty contest where everyone's holding their nose. There's another irony here. The more debt the US issues, the more treasuries exist. And the more treasuries exist, the more liquid the market becomes. And the more liquid the market, the easier it is to buy and sell treasuries quickly, which makes them feel even safer. The system is self-reinforcing, up to a point. Let's zoom out. This isn't just about the United States. Japan's debt-to-GDP ratio is over 260%. Italy, France, the UK, all running significant deficits financed by bond markets. China's local government debt is a black box of unknowable scale. The entire global financial system is built on sovereign debt. Countries borrow, banks buy that debt, central banks backstop the banks, and when things get shaky, central banks buy the debt directly, creating new money to do it. We saw this in 2008. The financial crisis nearly collapsed the system, so central banks began a program called quantitative easing. They printed money and bought government bonds, trillions of dollars worth. We saw it again in 2020. Pandemic hits, economies freeze, governments borrow unfathomable sums, central banks step in and buy the bonds, markets stabilize, crisis averted. But here's the question nobody wants to answer. If the central bank is buying the government's debt with money it creates out of thin air, is that a real bond market, or is it just accounting theater? Japan has been doing this for decades. The Bank of Japan owns nearly half of all Japanese government bonds. It's essentially the government lending to itself. And yet, the system continues, quietly, calmly, without collapse, which suggests one of two things. Either we've discovered a new form of economics where debt doesn't matter as long as you control your own currency, or we're all participating in a very slow-moving crisis that hasn't reached its conclusion yet. The official narrative is simple. Government bonds are risk-free assets. They're backed by the full faith and credit of the issuing nation. As long as that nation can tax and create money, the bonds are safe. And in nominal terms, that's true. The US will always be able to print dollars to pay dollar-denominated debt. But here's what that narrative quietly ignores: inflation. If you lend the government $100 today and they give you back $100 in 10 years, you got your money back, nominally. But if inflation was 3% per year, your $100 now buys what $74 bought when you lent it. You didn't default, you just got quietly robbed by the invisible tax of currency debasement. This is the escape hatch, the pressure valve. When debt becomes unsustainable, you don't default, you inflate. You make the debt cheaper in real terms by making the currency worth less. It's politically easier, it's harder to see, and it transfers wealth from savers to borrowers without anyone signing a law. The Federal Reserve has a 2% inflation target. Officially, that's to keep the economy healthy. Unofficially, it's a 26% wealth transfer over a decade from anyone holding cash or bonds to anyone who owns real assets or owes money. This isn't a conspiracy, it's policy, written down, defended by Nobel Prize winners, and it works until it doesn't.
The entire system rests on one assumption. People believe the promise, not because they've done the math, not because they think the debt is sustainable, but because everyone else believes it, so they believe it too. It's a shared hallucination, a collective agreement, and like all agreements, it holds until it doesn't. History has examples. Weimar Germany. The currency collapsed not because they ran out of money, but because people stopped believing the money had value. Wheelbarrows of cash to buy bread. Not because of a war, because of printing. More recently, look at the UK in 2022. The government announced unfunded tax cuts. Bond markets revolted. Interest rates on UK debt spiked so fast, the Bank of England had to intervene within days to prevent pension funds from collapsing. The government reversed the policy within weeks. The market didn't wait for a default. It punished the promise before it could break. Here's the fragile part. U.S. Treasuries are considered risk-free because the U.S. can print dollars and everyone accepts dollars. But that's circular logic. Everyone accepts dollars because Treasuries are safe. Treasuries are safe because everyone accepts dollars. If that loop breaks, there's no backup system, no global lender of last resort. The International Monetary Fund can't bail out the United States. There isn't enough money. So what happens if the bond market loses confidence? We don't know. It's never happened to the global reserve currency while the entire financial system depended on it. September 2019. A boring month. No recession, no pandemic. Markets were calm. Then, overnight, interest rates in the repo market spiked from 2% to 10% in a matter of hours. 10% for overnight loans backed by U.S. Treasuries. That's not supposed to happen. Treasuries are the safest collateral. Repo rates should be rock stable. But suddenly, banks didn't want to lend to each other even with Treasuries as backing. The Federal Reserve had to inject hundreds of billions of dollars into the system to keep it from seizing up. Most people never noticed, but it revealed something uncomfortable. The plumbing is fragile. The system that recycles treasuries through the financial system every single day is held together by confidence and liquidity. And when either one falters, the Fed has to step in immediately. It's not a market anymore. It's a managed system, intervened upon, backstopped, supported by the central bank whenever pressure builds. Which raises the question, what happens when the central bank itself becomes the problem? We've built a global economy on a foundation of promises. Promises to pay back money that was created to pay back other promises. It's recursive, it's abstract, and it's almost impossible to explain without sounding like a conspiracy theorist. But it's not a conspiracy, it's just the system we chose. Governments realized they could spend without immediate consequence. Banks realized they could earn fees by facilitating the borrowing. Central banks realized they could stabilize crises by creating money. And everyone realized that as long as no one panicked, it all worked. So we got more of it. More debt, more bonds, more collateral chains, more repo, more quantitative easing, more everything. And now the debt is so large that it can't be repaid. The interest is so high it requires more borrowing. The system is so interconnected that one break could cascade everywhere. But here's the paradox. The bigger the system gets, the more essential it becomes. And the more essential it becomes, the harder it is to let it fail. So every crisis ends the same way. More intervention, more support, more debt. It's not sustainable. Everyone knows that. But unsustainable doesn't mean it stops tomorrow. It means it keeps going until something forces it to stop. And no one knows what that something is. Here's what we know. The global economy runs on IOUs. Those IOUs are treated as safe, even though the math behind them is impossible. The system works because everyone agrees to pretend it works. And the moment that agreement cracks, there's no plan B. We're told this is normal, manageable, that debt to GDP ratios don't matter for countries that print their own currency, that central banks can always intervene, that modern monetary theory has unlocked some new understanding that makes the old rules obsolete. Maybe that's true.
Or maybe we're just living in the long, quiet pause between when the bill came due and when someone actually has to pay it. Because here's the thing about IOUs. They're only invisible until they're not. And when $35 trillion in promises start demanding answers, calm explanations and confident assurances might not be enough. The system works until the day it doesn't. And on that day, we'll all find out together whether the invisible IOUs were holding the world up or just holding it hostage.